In this presentation, we will calculate the amortization of a discount and the recording of the reduction of the discount, as well as interest on bonds issued at a discount. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here's going to be our data on the left side. We're going to enter that into our general journal and then post that to our worksheet. Our worksheet being in order: assets in green, liabilities in orange, equity light blue, and revenue and expenses in dark blue. Debits being positive numbers in our worksheet, credits being negative, the green 0 indicating that the debits minus the credits equal 0, or debits equal credits. Net income currently at $700,000. We can see that we issued the bond at $198,484. The face amount of the bond was $240,000. So that's going to be here, and that resulted in our bond on the books, $240,000, and a discount of $41,516. That being the difference between the face amount of $240 and the issue price $198. So we have this discount. So now what we're going to say is that we pay these semi-annually. We pay interest semi-annually, so we're going to record our interest payments. When we do so, however, we're also going to have to deal with this discount and the reduction of this payable. Why? Because this is going to be really due to interest in a way. This difference is due to the market rate being assumed to be different from the rate on the contract, and that's why we have this difference. So we're going to treat this reduction of the payable as kind of a type of interest, meaning we are going to expense it or put it on the income statement as we pay our normal interest payments, which in this case is semi-annual. So to do that, we'll first do a little calculation over here. We're going to do this with a straight line method. The effective method is a preferred method. It's going to be a little bit more exact in terms of applying the interest out, but the straight line is an easy method for us to understand. It can be used if the amount between the two methods is not materially different, and it really kind of lines up to what we see with other types of amortization methods. If we're amortizing or depreciating something like equipment, it's more like it's just a straight line method. So that's what we want to take a look at. We'll take a look at an effective method, a different type of method which will change slightly in terms of the amount that will be amortized each period in a later presentation. So what we're going to have here is we're going to start off with our discount, and we know that the discount, we could just pull it from our numbers. So I'm just going to say the discount equals this number. Now don't pull it from the trial balance, because that'll change the ending trial balance. If we pull it from the beginning trial balance, we can say, okay, that's our beginning number. And then the carrying amount is going to be the original amount minus the discount. So I'm going to take this number, I'm going to flip the sign, subtracting the discount from it. So in other words, it's going to be negative. I'm going to take the 240, so that makes it a positive. And then I'm going to say minus this 41,516. So in other words, what we're saying here is the bond's on the books for $240,000 minus the discount gives us what we actually paid for it at the beginning of the bond, $198,484. That's going to be the carrying amount before any payments have been made. We're going to make a semi-annual interest payments, and we're going to reduce the carrying amount or reduce the unamortized amount each of those pay periods. So that means we're going to take the amortization here, which is going to be equal to, it's just going to be straight line, this 41,516, and we'll divide it by the number of periods. Now this is a little bit tricky because there's 15 years semi-annual, so that would be 30 periods. So I'm going to divide it by 30. So again, this is actually a common problem, and there's a couple different ways we can calculate it. If we take the unamortized discount 41,516 and divide it by the number of years, what's given in the problem, 15, then we're going to take that and divide it by 2, because it's semi-annual, divided by 2, and that gives us this number about. It's rounded, as we can see. Or you take the 41,516 divided by the number of periods, which is 15 years times 2, divided by 30, and that'll give us the same amount. So whatever works best for you to think through that. Then we're just going to take the unamortized premium minus what has been amortized. So this equals this minus this and enter, and that's going to be the 41,132, and then the carrying amount is always going to be 240,000 minus whatever the unamortized premium is. So again, I'm going to do that with a little bit of a formula, negative of this number over here. Make sure to pick the beginning number because this number will change, so of the trial balance, and then minus, we're going to take the 40,132. So it's just like this one. We took the negative 40 minus the unamortized. We're going to take that same negative 40, or that makes it a positive 40, minus the 40,132. We'll take the negative of this 240. Make sure not to pick this one up. We're going to pick up the first one because this number will change as we make journal entries. And then we're going to subtract out the 40,132. So this is always the unamortized amount. We're going to take the original, the bond payable, which won't change until the end, and then we'll subtract out the unamortized amount. So it's just like this first one, 240 minus the 41, and then of course this went down, and now we'll do it again. So if we do this a second time, and note we're jumping forward in time, this is the bond, this is 6 months later, and then 6 months later because we're paying every 6 months. So now we're going to say this will be the same because it's straight line, the amount that we're going to amortize each month. And note, we're not actually paying this amount. We will be paying interest each time. This is going to be allocating out the amount of the discount that we're going to be reducing. So we're going to say this equals the 1,384. And then once again, the unamortized amount will equal what was unamortized before minus the current amount that we're going to reduce it by. And then the carrying amount, once again, will be negative of the 240, which doesn't change, minus the 38,748. And we're just going to keep on doing this all the way down until we've completely reduced this amount to 0, and we will then be at the end of the bond term. Now what we're going to do is we're going to copy this all the way down, and we'll see that this amortized amount will go down and down until it reaches 0 at the end of 30 payments. So to do that, I'm going to copy it down one time, this whole row, and then see what happens to it, and then we'll continue to copy it down. So I'm going to highlight these 3 cells or select them. Then we're going to use the autofill and see if we can just copy it down and see if it does what we expect it to do. So we'll copy that down, and this looks right. This looks right because this is just equaling the cell above it. This one is subtracting out the correct 2. That's what we would want. This one, however, looks funny. Why? Because it's picking up this cell, and that's not what we want. So what I'm going to do instead is delete this and try to do it again. And we're going to say, what if I pick up this cell? I want this not to change when I copy it down, and when I moved it down, it takes the relative one, it goes down. So to do that, I'm going to use an absolute reference. So this cell, I'm just going to say F4 on the keyboard, push F4, or type in a $sign before the H and a $sign before the 6. We don't need 2 $signs, but it doesn't hurt. So I'm going to say OK, and then we'll copy this down one time. I'll highlight it, copy it down one time. So there we have it. Now it looks like it's doing what we want. That looks right. That looks right. That looks right. So this is going to keep going down until it gets down to 0. And this is going to keep going until it gets to the carrying amount of 240. So we've added the dates, and note the year isn't here, but of course we're talking about the next year each time. So this is 6 months later from the beginning. Then we've got the end of the year 6 months later. Now we're in the next year, so we're always jumping up 6 months. So if we go then and we highlight this all the way down, I'm going to select these cells, going to go all the way down to 30 payments, or 30 of the amortizations that we're going to be making here, and just autofill this all the way down to 30. We could see that it does what we would expect. It's going down evenly by 1,384 till it gets to 0, and then we're at the 240. So at the end of 30 periods, at the end of 15 years, 2 times a year, we will be down to being left with just the 240, and this will be at 0. And then, of course, we'll make that final payment of the 240. So now what we're going to do is we're just going to record the first one of these. So we're recording this one. I'm going to make it a different color so that we could see it as we record it. So first question is cash affected. We're going to say it is not because of this spreadsheet, but because we're going to record both the payment that we make as well as the reduction or amortization of the discount at the same time. So cash is going down. So I'm going to say I'm going to copy cash. I'm going to put that on the bottom. Right click and paste 1, 2, 3. Now the amount that we're going to pay in cash is going to be equal to the face amount of the bond times the carrying rate, or the amount on the bond. Meaning we're going to pay in accordance with the contract on the bond. So we're going to use the two amounts that would physically be on the bond. The issue price is not physically on the bond, neither is the market price. The things on the bond, the promise we made, is to pay $240,000 of the face amount times the interest rate stated on the bond. So that's what we're going to have now. To calculate that, it's going to be $240,000 times the rate on the bond, 0.066%. That would be for a year. We're going to divide that by 2, so 2,700. Or we could say, well, okay, well, the rate is 0.06 for a year. If we divide that by 2, it would be 3% times the face amount, 240,000. So two ways we can do that. Let's do that over here. It's going to be a credit, so I'm in E4, negative 240,000 times 0.06 divided by 2. So there we have it. I'm going to indent this, home tab, alignment, increase indenting, probably done for you already. Okay, so then we're going to have the amount we paid, the reduction in the discount. So here's the discount. We need it to go down. It's helpful to have a trial balance because it'll tell us that a discount has a debit balance. And you know a discount has a debit balance because it's kind of the opposite of the bond. It has to bring the bond down. The bond payable is a liability. This must have a debit balance then. In order to make it go down, we're going to do the opposite thing to it. We're going to credit it. So I'm going to copy, right-click and copy and put that in C5, right-click and paste 1, 2, 3. We're going to increase the indenting, and that's going to be a credit, and that's going to be a credit for the amount we determined over here. So I'm going to do that with a formula, negative of this number. Then we need a debit, and that debit is going to go to the bond interest, the expense. So I'm going to right-click and copy. Expenses have debit balances. They only go up in the debit direction. Put that in C3, right-click and paste 1, 2, 3. It's going to be the sum of these two, 2007 plus the 1,384. Now this is the part that's really kind of confusing to most people because we can understand why we're expensing the 7,200 because we paid that. It's interest expense just like a loan. This we didn't pay. Why are we doing it? Because the difference between these two, when we put it on the books, is the difference between the carrying value. It's the difference between the face amount of the bond and the issue price. And the reason for that is a difference in interest rates between market and the bond rate. So therefore, we're going to put this difference to interest, and we're going to record it into interest as we go through the bond term. So we're going to add these two up. I'm going to do that with our negative sum formula. It's going to be 8,584 in D3 negative SUM. Double click the sum function. Now you could try to move this out of the way or go from the bottom to the top, or you can move this out of the way and go from the top to the bottom. There it is. If we post this out, here's the bond interest. Here it is here. We're in the middle column in I-12 equals. Point to that 8,584, bringing the balance up, net income down. Then we've got cash. We're going to be in I-3 equals 2007, bringing cash down. And then the discount in I-7 equals, pointing to the discount and enter, bringing the discount down. Note what is not happening. We're not paying the bond down. And some people have a problem with that because often we're used to loans like a mortgage where we pay both interest and principal. Here we're not paying any of the principal until the end. Therefore, this is just going to remain on the books. All we're doing is paying the rent on the money, the interest. We're not paying the principal down. We're going to pay it all off in a lump sum at the end. Now we can see we match the amortization table. This number equaling this number, the unamortized discount. The carrying value, if we take this minus this, 199,868 is here, 199,868. Now we'll do this one more time. I'm going to make this blue again, and I'll make this one green. Let's do this one more time. Very similar journal entry as of the end of the year. So that's why I kind of made this 12/1 instead of 1/1, so we can have two payments in the same year here. So we've got 12/1, and same thing, we're going to pay cash. So the cash, I'm going to copy the cash. It's going to be the same journal entry and same calculation. So we're going to say this is a negative, so I'll put negative 240,000 face amount times 0.06, 6%, the contract rate, divided by 2. So there's that, and I'll indent this, home tab, alignment, increase indenting, then the discount, copy, paste. I'm going to paste this one normal so that it'll indent for us. And then the amount then is just going to be this amount, but it's going to be a credit. So same amount because we're using a straight line method, negative of that number. And then those are going to go to the expense. So I'm going to copy the expense, same transaction, negative sum, adding these up, 8,584, using the plug formula, negative sum. And then again, if this is in the way, it's faster to just go from the bottom to the top, or you can move it out of the way, but there you go. Okay, then we'll post this out. We'll have bond interest. We're going to say plus 8,584, bringing the interest up, net income down, cash, it's going to go here, double click, something's in it, go to the end of it, plus 7,002, bringing the cash down, and then the bond discount here, double click, go to the end of it, plus, and we're going to pick up that 1,384 and enter. Now we're left with, once again, the bond doesn't go down, we're just paying off the interest, and we're reducing the discount to interest. And note, you could do this with two journal entries, and it might make it more sense to some people, meaning we could make a journal entry saying cash is going down by 7,200, and then debit the expense, and then make another journal entry saying that the bond discount is going down by 1,384 and debit the bond interest expense, debiting interest expense twice. Most textbooks will combine the two, however, in practice, so it's probably good to see them in that format. But if it makes sense to you to break them out, then break it out. Okay, so then we're going to have this matching out over here. So we've got the 240 minus the 38,748 is 201, 252, that being the carrying amount. And of course, the unamortized amount is the 38,748. For more accounting information and accounting courses, visit our website at accountinginstruction.info.